The American Foreign Policy Council. This is an event hosted by the Central Asia-Caucasus Institute, and we are delighted to welcome you here today. It's my distinct pleasure to introduce Dr. Mamuka Tsereteli, who will be moderating this event. He's a senior fellow here at the Central Asia-Caucasus Institute, among many other things, including nothing else. Nothing else he wishes to cop to right here and now. And we have Mr. Subir Lall, who's the Deputy Director, Middle East and Central Asia Department at the International Monetary Fund. What we're going to do is Mr. Lall has a few slides to go through to talk about the situation in Central Asia and the Caucasus, and then we will definitely open for questions. We want to really hear from all of you and have this be a very interactive session. And as I said, this is recorded, so we will post it on YouTube after. When you do ask a question, be sure to state your name and affiliation, so we have that as well. And then also I'll just put a plug for our books again. Please take a book or two as you're leaving. We want the books out in the world. Give it to a friend. We don't want them just sitting in our office. A lot of the analysis still holds, even if the specific foreign policy events are, in the past. So I think it's worth taking a look at one or two of the analysis if you're interested. And with that, Mamuka.
Thank you, Laura. Thanks for everyone coming and joining us today. This is a continuation of our 2 decades long tradition of having presentations from our colleagues from IMF about economic development, outlook for economic development in Central Asia and the Caucasus. We passed through different times in the last 2 decades, ups and downs. We are living now during very interesting times, of course. Lots of conflicts surrounding region. It's no longer conflicts, we can call them large-scale wars now. And obviously it affects developments in the region. But it shows, as Subir will demonstrate, region shows very interesting resilience in these times of challenges. And I think multiple factors are contributing why region is doing relatively, actually very well relative to other regions of the world. And we'll talk about those reasons as well. And you are obviously all encouraged to ask questions after the presentation, and I'm very optimistic that we'll have a very lively discussion. One little maybe footnote here is that the outlook for economic development from IMF is updated every 6 months. This is based on data coming from April, as I recall. There will be another one coming during this fall. We'll try to come back and have a kind of update session maybe sometime later this year or early next year. So, very brief introduction to our guest, Subir Lall. As Laura mentioned, Subir is a Deputy Director for the Middle East and Caucasus and Central Asia Department at IMF. He worked in many different countries of the world, in Europe, in Southeast Asia, and some of the interesting success stories of reforms like in Portugal and other places. So he understands this region very well because he's been in the places very similar to where Central Asian countries and Caucasus countries are today. So Subir, the floor is yours, and thanks for being with us today.
Thank you, Mamuka, for the introduction. Thank you, Laura, and good morning, everybody. It's nice to see all of you here. We have a full house. I'll make a brief presentation in 2 parts. The first will be just looking at economic developments recently and based on our latest update from April, data through April. And then I'll focus more on the forward-looking part and what it means for the region and what the region needs to do to sustain its growth performance going forward. So let me start with just a snapshot view. Which is first with growth. And you can see from the chart on the left that the region, we call it the CCA region, Caucasus and Central Asia. And you can see that it has consistently outpaced other regions and advanced economies since 2022. That's the red line over there. So AEs is advanced economies or income countries, as they're called, and EMDs is emerging market and developing economies as a group. So the CCA region clearly not only has it outpaced growth, but in fact growth has picked up over the past few years. One thing that you often hear is, and the questions we get asked, well, is this a change in the economy, the growth potential of the region, or is this a cyclical development? So we estimate what's called potential growth, is what's the rate of growth the economies can sustain without overheating and leading to imbalances or inflation. And we recently updated that. So the chart in the middle shows how the economies are doing. And those are the blue bars, and relative to what their potential growth is, which are the triangles that you see there. And what you can see is that growth in general is higher than the potential. And as I said, potential is a growth consistent with stable inflation and the full use of production capacity.
Subir, if I may, so AEs and EMDs, which are these countries?
AEs
for the
are
audience to know.
Advanced economies, so you have Western Europe and obviously the United States and Canada and so on. And emerging market developing economies is pretty much all other economies except well, actually it pretty much covers the rest of the world except the advanced economies. So the second part was on how growth is exceeding potential. And so in that sense, it's not a surprise that because of the stronger growth momentum, you get higher inflation if the economy is operating above its capacity. So the chart on the right, you can see that, for instance, in 2025, the inflation was close to or above the central bank's targets in 5 of the 7 countries of the region. So the blue bars, and this is where the targets are more or less, or the target ranges in some countries. So without doubt, the economies have shown a strong performance in the past 3-4 years, benefiting from strong external tailwinds. And as you can see from the chart on the left, the price of key commodities, oil, for example, gold, which is the dotted line, they've remained favorable for many exporters, since we have gold exporters in the regions of Asia, for example. And they have supported external revenues and buffers. And since the start of Russia's war in Ukraine, remittance inflows, mostly originating from Russia, have also been elevated. And you can see that in the middle chart, that the remittances in many countries substantially exceeded their pre-COVID averages, which are the blue bars. And the dots are where they are the maximum between 22 and 25. So especially remarkable that remittances, for instance, Tajikistan are more than 50% of GDP. In fact, the last print I saw was it was closer to 55% of GDP. Similarly, also very high in Uzbekistan, a much larger economy, and in Kyrgyzstan as well. So you're seeing all of that happen in the last few years. And of course, remittances also help. They boost domestic demand, they boost consumption at home, construction, and so on. And there's been strong external demand, and export volumes have benefited from that, including, in some cases, due to intensified trade with Russia, as regional trade patterns have shifted since the war in Ukraine. And export volume growth was also substantially higher between 2022 and 2025 than in the 5 years before the COVID pandemic, which are the red bars. So while we often talk about global uncertainty and global policy uncertainty, the region has benefited very well, and a lot of it has had to do with these external factors that have supported growth, the commodity prices, remittances, and so on. Just a footnote now, the war in the Middle East from this year has, it risks changing this favorable balance. Commodity prices have risen sharply, and they do help commodity exporters, but oil importing countries in the region and are facing higher input prices in some cases. And they already have, some of them have high inflation pressures, as I mentioned. The war has also disrupted trade flows for many countries. It complicates logistics and contributes to higher transportation costs. And also importantly, there is a risk to food prices because fertilizer prices are going up, and that could show up as a risk to food prices across the region, and which will also impact inflation as well as consumption. And of course, overall escalation of conflicts can have a negative impact on business confidence and FDI, but we haven't seen much evidence of that so far. So a quick word now on the policy frameworks that we look at. Our analysis seems to suggest, and there's a lot of information here, but let me just give you the overall bottom line. Macroeconomic policy frameworks for countries in the region have strengthened. Now, they all came from a common history, and they were all members of the CIS and the Soviet Union before that. And so it's taken time for macroeconomic policy frameworks to adapt and become more compatible with a more market-oriented economy. But what you're seeing is that those frameworks, essentially monetary and fiscal policy and financial policies, are all modernizing, not all at the same pace, but they're getting better and more suited to the underlying economy. On the left-hand side chart, what you see is the correlation between public spending and GDP for 2 points in time. One of in the y-axis, that's the vertical one, as of 2015, and more recently as in 2025. And 2015, 2025, those 2 years, 10 years apart exactly. And so a majority of the region that you see is showing an improvement. That's the bottom line takeaway from that in their fiscal policy, in the sense that their policy has become less pro-cyclical. We like that policies are less pro-cyclical, because otherwise what happens is when there's a boom, fiscal spending even grows even higher, it causes overheating, and then you can end up in boom bust cycles. But what you're seeing now is that the economies by and large have become less pro-cyclical. They moved to this quadrant here. So even when the economies are booming, the temptation to spend is not as high as it used to be 10 years ago. And that's a good thing, because that means the buffers are there to allow the spending during downturns and when slowdowns happen, which is in fact ideally what you want is counter-cyclical fiscal policy to smooth out the downturns, but to get out of the way of the private sector during periods of upturns and expansions. And this counter-cyclicality helps also in managing inflation, because it constrains overall aggregate demand in the economy. As I mentioned before, given that you are seeing economies already operating above potential, if policies were more pro-cyclical fiscally, then that would be pushing even further beyond the economy's capacity. So, but fiscal policy, having become less pro-cyclical, has helped reduce the pressure on monetary policy a little bit. Although monetary policy stances do remain a bit uneven, but they are tight in some cases, but less restrictive than is probably needed at this point. But the bottom line is what you can see in the middle chart is that the real interest rates have declined in some countries, even as inflation was rising or stabilizing. And that, in fact, sometimes when you need to tighten policy means the real interest rates need to rise. But what we found, the evidence was that countries that had larger increases in real interest rates also experienced larger declines in inflation, which is how it's supposed to work. And finally, on a word on financial policies, which is macroprudential policies and monetary policies that have helped reduce financial vulnerabilities, which again reduces the likelihood of boom bust dynamics. And that's in the right-hand side chart that shows that real credit growth in the region that had reached quite high rates in the post-COVID period, but now it is a lot lower last year. But then again, progress is uneven across the region. And the two test of these frameworks that I tried to quickly cover will come when growth slows and external conditions become less supportive. And we are seeing some easing from the very rapid growth. It's still very strong in the region, but some easing from really, 4 years of blockbuster growth so far. Because of these policy frameworks, what you have seen is that countries have taken advantage of this to rebuild policy buffers. And you might recall that COVID actually exhausted a lot of policy buffers for countries across the world. But now you can see that in most countries in the CCA region, public debt has been reduced. And sovereign debt, in fact, importantly, remains low by international comparison. And then the middle chart shows that the nominal effective exchange rates, which we calculate, have appreciated substantially. Nominal effective exchange rate being exchange rates not vis-a-vis one currency, but weighted across all trading partners. And that also, of course, helps with inflation because a lot of the inflation is imported. So when exchange rates appreciate, there's less imported inflation. And so the exchange rate movements helped contain inflation pressures. Of course, strong appreciation is a concern if there are external imbalances and it hurts competitiveness. However, what is encouraging is a lot of countries in the region have helped use this inflows and pressures on the exchange rate to rebuild their foreign exchange buffers. So the chart on the right shows how the foreign exchange reserves of these countries have increased and against their exchange rate appreciation. And it shows that reserves increased considerably during this period, and especially even as currencies were appreciating in the region. So what this shows is that, there is a cost from exchange rate appreciation, but you get benefits, and it brings us back to the issue of that you need to do reforms to build non-price competitiveness. Your external competitiveness cannot be relied simply on exchange rates, but things like business climate and things that I'll come to later will become more important. Now, we talked about resilience of the region over the past 4-5 years. And what we did was we looked at some of the underlying institutional frameworks that countries have. And one of them was, on fiscal policy. You can see the strength of fiscal rules over time. So how strong are fiscal rules and constraints which the economies implement to make sure that spending, for instance, doesn't get out of hand or they don't have competitive tax cuts. And you can see that our colleagues in the Fiscal Affairs Department did this computation. And you can see for the Caucasus and Central Asia, there's still some room to grow, but you have seen improvements over time. And especially if you compare that with the peers in Central and Eastern Europe, which is the dotted line over there. So stronger fiscal frameworks, well-designed fiscal rules can help build buffers over time. Another measure of improving frameworks is dollarization, something that many of the countries in the region have. When domestic monetary policy frameworks are strong, inflation is low, and the exchange rate is credible, then dollarization tends to go down. And we are seeing that over time, that the deposit dollarization, so in terms of people holding deposits in dollars, has been declining more or less steadily, which shows that people have more confidence in the domestic monetary policy frameworks. And it also helps with monetary policy management. So it's a good sign. And then, jumped ahead. And there is a considerable potential for growth coming from structural reforms. And this is something I'll come back to in a second. And it shows the impact on GDP growth of closing gaps with the top regional performers. The top regional performers in terms of structural reforms is Georgia in the region. So what we do is try to compare that if countries close the gap of reforms relative to the best performer, how much would that increase their annual growth rate by? And that's why Georgia is not here, because we're comparing it against reforms in Georgia, and you can see that there's considerable upside potential from structural reforms. And this brings me to the forward-looking part. As I mentioned, growth has been very strong since 2021. And another way of looking at it, of course, is to look at growth performance since 2022 compared to the period before. And so cyclical momentum, as I mentioned, has played an important role. And but what it also means is that the pace of growth is unlikely to be sustained without credible reform. So I'll move quickly from that. And just one area that I wanted to highlight, which I will explore in some more detail, is there's something called the Global Connectedness Index. There are many indices like this. This is prepared by DHL and New York University, and it looks at it's a snapshot of economic integration. And it shows that the countries in the Caucasus and Central Asia, based on this index, are much less connected than in the comparator. We always use a peer of, say, Central and Eastern Europe, which had a common history in terms of their economic, the central planning model. Now let's look at some dimensions of this integration in detail. The chart on the left, you can see that trade openness, which is measured as sum of exports and imports over GDP, excluding fossil fuels, because that's more or less a commodity that comes out of the ground. It remains limited in the CCA. And non-oil trade helps us have a clearer comparison across countries. And in fact, it shows that openness has declined among oil exporters, because I guess oil exports have been booming in many cases. And there's a bigger reliance on hydrocarbons. And oil importers have improved somewhat modestly, given by stronger integration.
Who are these countries?
Caucasus, Central Asia, oil exporters and oil importers, OE and OI. So that would include, for instance, Kazakhstan and Azerbaijan and so on, and the rest of OI. And so this is one way to show that greater integration in terms of openness would help in the non-commodity and non-oil sector as a driver of growth. And we have some gravity model estimates which compare what trade would be expected to be given countries' economic size and geography and policies and other characteristics. And they reveal a sizable gap across all the countries, across goods, services, and manufacturing, captured by the negative value. So if you're below zero here, that means that based on what a global model would tell you, based on all comparators across all countries in the world, you're really underperforming along these dimensions. For instance, in manufacturing or services, merchandise, in almost all cases, opening up the economies would help lift those closer to the zero bar and then go above that as well. And of course, so since we're talking about openness and connectivity, it seems one of the important things is what are the opportunities for the region? And so given the war in the Middle East could actually increase the returns from regional trade coordination and improving the infrastructure around trade in the region, because the value of alternative trade routes from east to west and back has increased now, and given that there's high geopolitical uncertainty and economic policy uncertainty in some cases, so this is an opportunity for the CCA region to provide an alternative. And because even as current tensions ease, this episode would highlight that there is a need for alternative routes to mitigate risks from reliance on specific routes like the ocean route or the northern corridor and so on. So just simply from the point of view of risk management in trade, it would make sense to have alternatives, and the CCA region can provide that. But this requires scaling up of infrastructure and improving the quality and investing in more modern systems in the region, and strengthening coordination between institutions across the countries in the region, including harmonizing their customs rules. And of course, it would also mean it means creating more space for the private sector in these countries and in the region as a whole to use logistics facilities and ensure more seamless integration of value chains for trading and movement of goods across the region. So now the reforms that I quickly highlighted would not only help connecting with the rest of the world, but it would also help countries connect with each other. The countries in the CCA region actually do not trade that much with each other, as you might expect, given their geographical proximity. And intra-regional trade remains very low compared to other regional blocs, and with little progress over time, as you can see in the chart. It's actually about at the bottom there. Relative to developments in the European Union, that's the EU, and the US, Mexico, Canada region, USMCA, the Association of Southeast Asian Nations, ASEAN, and then, of course, the CCA region that we've used. So you see the gaps are quite large, and some regions trade quite a lot with each other, but not so much in the CCA. And then the chart on the right, again, it shows estimates from the gravity model, what trade should be given intra-regional proximity. And you see there's very little manufacturing trade going on between the countries, or merchandise trade for that matter. There is some in services. I think workers travel across borders and so on. But overall, the region, even intra-CCA, is underperforming its potential. And so that gives us, in a way, optimism that more can be done and reap quick rewards. We don't have to look very hard to see where the region needs to go. So now coming back to the broader theme of integration, there is a scope for one needs to do domestic structural reforms, of course, and combine that with an agenda for deeper regional and global integration. Trade integration can support diversification of these countries, many of whom are heavily reliant on commodities, and it can improve productivity, while deeper financial sector development can facilitate investment and risk sharing. Here too, as you can see in the middle chart, the CCA countries score below the average of Central and Eastern Europe, for example, which is the leftmost part in terms of the financial sector development. And the right-hand side chart summarizes the results from an analysis that we have on potential GDP gains from trade-related reforms in the CCA countries. And you can see, and this is based on reforms in 3 areas: infrastructure, regulation, then tariff and non-tariff barriers. And closing the gap with advanced economies for their average levels by only 20% would make significant gains in terms of GDP for all the countries in the region. So this is just simply the level GDP impact that could happen if these gaps were closed by a fifth of where they are. And I mentioned earlier, by the way, the DHL NYU Global Connectedness Tracker, which we saw, and that tracked global flows of trade, capital, information, and people. It's a comparative estimate, and what these charts also show is that connectedness and other factors are lower than they should be. I'm close to the end, so bear with me. So what are we talking about when we say we should improve trade and integrate more? There's room to improve the scale and the quality of trade. Export sophistication remains low in the region, with most countries ranking near the bottom of what's the Global Economic Complexity Index, which means how complex are your exports and how much value added are you bringing to the exports that you push out into the global markets. And the lower value means greater complexity. And so what that means in practice is that exports are concentrated in low value added commodity-based products, And that limits the upside potential for productivity growth. And it also limits resilience to shocks because commodity shocks then feed through the entire economy. The middle chart shows market penetration. That too is quite weak, with CCA exports only a very small share of the potential global markets. So the region is foregoing a lot of growth opportunities by not tapping into the whole global market that is there for it.
Yeah, this whole lane is Central Eastern Europe, so
that's the comparison, that they have taken much better advantage of global opportunities. And it holds back competitiveness and innovation because you want to be, to use the soccer analogy, if you play in local clubs, you'll only get so good if you play in the Premier League, you suddenly become much better, and then you end up in the World Cup. So that's where we want to be. And then, as you see in the right-hand side chart, participation of global value chains is also very low for the region, with the CCA countries largely outside of cross-border production networks. And this restricts access to technologies, spillovers of knowledge, and opportunities to move up the value chain. And I did have a last chart here. This is, again, to show how closing the gap with advanced economies by only 20%, and this comes from a study we had done some time ago, 2 years ago, can greatly improve exports in both oil importing and oil exporting countries. And of course, that also means not just exports, but also improves the growth prospects of these countries. And this is only by closing the gap by 20%, which is not overly ambitious. I did mention financial sector development as an important component because that helps raise capital and make sure that new businesses and new industries can be set up and create more employment opportunities. This is just a very quick summary. I won't go through all of them of areas we have for additional reforms. We can, of course, talk more about that if you would like. And then I'll leave you with a few key messages, which is that growth is strong, but we do expect it to moderate as region-specific tailwinds begin to fade or normalize as happens. And one needs structural reforms to sustain the growth momentum because there's always, a few good years and you think this is the new normal, and we caution, and that's partly our role, so that this is, economies go through cycles and then it's inevitable. So structural reforms could help maintain and lengthen the expansion part of the economy without overheating. For the CCA, a big unexploited part is integration, both regionally and with the rest of the world. And this will require closing gaps in infrastructure, tariffs, regulations, and those would help boost exports and competitiveness and hence GDP. But without local reforms, economic integration alone would not do it because it will not sustain durable and inclusive growth. Let me stop here. Thank you.
Okay, thank you. Thanks, Subir. Very comprehensive presentation. Let's keep this maybe. Yeah. Before opening to the audience, I just wanted maybe to comment to one question from me. Most of these countries are still heavily state-dominated economies. So state has a large-scale kind of ownership in assets, and they're also involved in the areas that normally you would expect private sector to dominate, let's say services and so forth. So where you see this trend kind of, do you see this states maintain this level of participation in the economy, or do you see kind of, I know you just suggested structural reforms, which means privatization and other things, but where you see this trend will go? Are state authorities more comfortable with the current status quo, or do you see desire to move forward with some?
Yeah, I mean, that's a very good question. And obviously, the region is not uniform. There are some who have made more progress than others. So maybe we step back a little bit. So what is the role of the state in the economy? A large part is state-owned enterprises, and many of them are outside necessarily the budget sector, and often the state exercises its role in the economy through SOEs. And clearly, some countries have made a lot of progress, and this is a legacy from the past, from the Soviet Union times. So it's been there, and to answer your question, there is progress being made, and I think there's more awareness that the role of the state needs to shift from being a producer of goods to an enabler. And let's get out of, and in fact, it's one of our key recommendations for growth is to reduce what we call the footprint of the state in the economy, to provide essential services or where there's a public good component. Just to give a background, what I found interesting through looking at the region and traveling to the region is there is sometimes an idea, and this again in some countries, or even not even countries, among some individuals, that most of the problems in the economy come from a supply side. So if you have high inflation, you should just produce more, and inflation will go away. Or if you have, you should just produce more, and then the SOEs are very handy because you can just tell them to produce more. The idea of potential growth and demand management, I think by now most of the policymakers have it, but there are some who have been more familiar with the older model where supply was the main thing, like Soviet Union with the GOS plan and the single GOS plan, where it was all about industrial policy and resource allocation. So there is a bit of that legacy feeling that if you just produce more, and so the idea that you should actually restrain demand can sometimes meet a lot of resistance, and that's I think where the SOE universe fits in, because it gives a sense of appearance of control on the economy, but not necessarily in a good way. It actually holds back the economy's potential.
Okay, now we'll open. I'll just make one comment. When I see sort of what drove this growth, of course, external factors were very important, but I think FDI was an important factor, and the building up of the bureaucracy in the state systems. Because it's state-dominated economies, you need to have more qualified people, and I think we see in all the countries in the region. I just traveled in Central Asia. I saw central banks, the Ministry of Finance, all these other institutions have different type of people than they used to have. So this contributes, this growing human capital contributes to better management of the economy. There are some other factors, of course, but commodity prices, let's say, and so forth. Okay, first question comes from David, and next.
Thank you. Thank you very much for.
Please introduce yourself.
I'm David Mamuka, former Russia professor at IRI. For someone like me who has fear of numbers, it's very interesting. This. My question is, how much of these numbers are skewed by the war in Ukraine? The legend has it that Georgia's economy is sustaining itself, or any other economy in the Central Asia, that it's because of it took some burden of Russia, or as a channel, and a lot of money stays in the region that goes back and forth to Russia, and the shadow economy is place and everything like this. So how much is it real, and how much is it a myth?
Good question. I wouldn't call it a myth. I would say more what are temporary factors and what are permanent factors. The factors are real. The growth numbers are real. The question is it sustainable or not? So to use your example, it's true that a lot of very highly qualified people have, for instance, moved to Russia, to Georgia from Russia, set up their own businesses. And in fact, you are seeing services exports from Georgia and I think Armenia as well pick up. So it is happening. And the question is, how does it translate into sustained growth in the future? So I think the other aspect is we talk about commodity prices. It is elevated, say, oil prices with a lot of the global oil market production being taken offline. and that helps regions, and then it creates its own domestic demands, and that also boosts import from other countries. So it's a cycle that gets set up. So if oil prices were to fall or were to come down or normalize, what does it mean? That's the real question. But what you're seeing, I mean, this has happened. This growth is there, in all the countries, in the Caucasus as well as in Central Asia.
My name is Catherine Putz. I'm a journalist who covers Central Asia. And I wanted to ask you about structural reforms. And I see that phrase a lot. Can you be a little bit more specific about what structural reforms Central Asia in particular need to pursue, and maybe what are some of the barriers to those reforms? We talk about privatization, but what are some of the barriers? Why not privatize? Why are these governments sort of holding back on some of this structural stuff?
Okay, I wouldn't focus on, I wouldn't say, if I had to put a big sort of envelope around all the reforms, I would say it's not, privatization is one element, but it's more about market-oriented reforms. Making markets the degrees of everything, of course, but in general, most of these countries need to continue on the path of moving more towards a market-based allocation of resources. So not business-friendly necessarily, market-friendly, which is a bigger concept than just business-friendly. Because if you privatize and you give a government monopoly to a private monopoly, you're not going to get a huge lot of benefits. But if you make it more market-friendly, there's more competition, price signals matter. Those are the kinds of things that will help boost productivity and more efficient allocation of resources. With state-owned enterprises, often what you find is instead of adding to the economy, they're actually subtracting because they're not necessarily run the most efficient way. And so the overall, theme has to be more market-friendly and relying on a more market-based allocation of resources. And then from that come a lot of other reforms, including what I have here. So, divesting state-owned enterprises to free up resources. Capital and labor should be able to move to its most productive use. And the financial system and the real economy need to be able to support that, because otherwise, you're losing opportunities to do much better. To give an example, in many of these countries, the banking systems are still dominated by state-owned banks. If you're an entrepreneur trying to go into a new sector, you're going to have a really tough time starting up or getting finance. So that's why, it's in a very basic way, capital and labor need to move to their best possible use in the economy. And then government's task should be, focusing on education, on building infrastructure, physical infrastructure, also other things, digital infrastructure now becoming more and more important. Training, education, not in producing stuff necessarily.
Next one, follow-up.
Yeah, sure.
Would this include, because you talked about labor, would this include like labor reforms when it comes to sort of labor rights, not sort of organized and really difficult in Central Asia? And I think that's an aspect that's not always sort of seen as structural reforms, but clearly if labor has rights to go to a different job, go to a different sector, start a different business, that starts to respond to the market the way that you're talking about, as opposed to a state sort of direction. But it's a tricky thing.
Yeah, so each country is different, but labor reforms would cover a number of different things. One of the things in the region as a whole is generally average levels of education are quite high. The question is, are they getting the right kind of education? Do they have the right kind of skills training? And are you producing graduates that are suitable for working in what the future job market will look like, rather than a formal job market dominated by state-owned enterprises or government employment? That's, to me, the big question. And that takes time, but that's something that clearly will have to be part of the reforms to make sure that you have a labor force that is ready. Some of the countries are adding large numbers to the labor force on an annual basis, but you need to provide the right skills. I think that, to me, is the first order priority, is to make sure that and that they complement the new private investment that comes in, so labor and capital come together. I think that's going to be very important for the nation. Thank you.
One example of structural reforms is that, let's say, in Uzbekistan, during last, I think, 2.5 years, they increased energy prices several times. Last one in May. These are not popular steps, bringing prices to market kind of level, closer to market. So this is very essential in order to use proper utilization of energy resources, not to waste it and so forth. So this is one example of again, structural reforms. Yeah, bringing market kind of driven.
That's an excellent example. Because what happens is otherwise, when you have these kind of subsidies or other things, you in fact force investment into capital intensive sectors, heavy industry, that kind of stuff, whose business model relies on subsidies. And that doesn't create that many jobs. Instead, you don't want to necessarily favor capital intensive industries. And in fact, private sector should provide that capital. And if job creation and improving living standards is a goal, then these kinds of distorted subsidies can create real problem, a drag on the economy.
My name is Stanley Ashridley, representing myself. First of all, it's very good to see younger people being still interested in economic policy and policy in general. So kudos to policy central agencies. So what I'm going to say is not going to be popular. But I'll start what Mr. Magraza mentioned, that those numbers that you represented definitely have to include, in my not very humble opinion, a big chunk of war-related impact. And that impact is not only some smart people coming to Georgia. That impact is enormous amount of money coming with these people to Georgia, Armenia, Central Asia, Azerbaijan, any other place. On top of that, I would say sanctions or avoiding sanctions economy. As an example, the biggest trade partner for Georgia in last year was Kyrgyzstan. So neither Georgia or Kyrgyzstan have enough goods to trade. They're both very relatively poor countries, to be honest. So what makes difference there, or Armenian trade with Russia, like quadrupled or even more. So those kind of factors, I don't see them, I don't even know how to reflect in your numbers, because these are not remittances, these are not, the classical economic gains. It just happens without you doing anything. It just happens. But the numbers are substantial. If your major trade partner is, certain poor country, so there's something wrong. Definitely not sustainable, but it's happening. So my question would be how you would reflect those factors in your number. Number one. Number two, I think it's a time to forget about the myth that there is a state-owned enterprises in Caucasus Central Asia. None of these enterprises are state-owned. On paper, yes. On reality, no. They are owned by people who are owning those countries. One individual or group of individuals or families or political elite. You can call it whatever you want. They are not really a classical state-owned enterprises as we knew it after collapse of the Soviet Union. Now, how they are managed, that's a different story. For some cases, they are managed the way they are because of social, diffusing the social pressure, or any other forms of subsidies. I would call it subsidies. But I think we have to mentally get rid of the notion that these are actually, state-owned enterprises in the classical understanding, like in France or any other place, which has an economic impact on it. Third,
Okay. So I think we need to have a time to answer questions.
Let me clear. This third factor is that the trend during these uncertain times is certain developments, not more integration, but less integration. If we take the most important factors of the driving the economy in the world, the data economy or the AI, every single country is trying to actually not be integrated, but sovereignization. And we see that happening everywhere. So they don't seek more integration because this integration then increases the dependence if something bad happens. So I would appreciate your opinion on this one. Thank you.
Okay, thank you. Well, to the extent that economics is a science, I would say I'm a scientist. Okay, I mean, you can argue. Let's go with that.
That's a diplomatic way of avoiding some questions.
No, I will come to the question. So that
You can say you're philosopher, but
well, yeah, that's true. But well, that's a whole different discussion. But I go by data, okay, and I go by evidence, not by impressions or anecdotes. So let's look at some of the points you made. Yes, you have seen trade diversion and a rerouting of trade. We do see that in the data. It's in the balance of payments data, and I would invite you to read our rather excellent country reports on Georgia, Kyrgyz, or anybody. You'll see that. And then also how it translates into GDP. So we are, and balance of payments data, I mean, everything that is recorded goes into our analysis. If it is not recorded, I don't have any evidence of that, and nor does anyone else. So we go by the official statistics. So based on that, yes, there is trade rerouting part of it. So the example you mentioned, that there is a big trade for sure, and transshipment from Kyrgyz to the Russian Federation. That's in our staff reports. It's not like a big secret or anything. And they are part of an Eurasian Economic Union. So the trade between Kyrgyz and Russia is not necessarily recorded because as an economic union, you don't have to stand at a border control and report things. So there are data gaps for sure. But the overall picture is a consistent one. And we do say that, yeah, and that's exactly the question, that if you have so much of your GDP coming from transshipments or exports, is it sustainable? And that's I think a valid question to ask. And as I try to point out, we think these are temporary factors, that they will fade eventually. And then you'll go back to the economy's potential. We do not believe that their potential is suddenly now magically overnight grown, from whatever it was, say 4.5%, 8% or so. We've never seen that in the history of any country. And we based on our analysis, that's not what we're seeing now. What we're seeing is the economy is operating above potential. Now, I think you made a rather strong statement about that SOEs are a myth and, ownership is control. And, I mean, I will not comment on that, but what my broader point remains that those entities are not performing to the best potential of the economy. So I think in that sense, what you're saying is not inconsistent with what I'm saying, which is that a well-run company that is not under the control directly under the state would probably add more to the economy. But then subject to the condition that it needs to operate according to market principles. Having an oligopoly or a private sector monopoly is not going to do a whole lot for anyone. It's not a magic bullet that will solve all problems. No, it needs to have competitive principles, anti-monopoly rules. You need the whole business-friendly reforms. And I think I added one of the things about and that's what we mean. And that's why I say it has to be market-friendly, not necessarily business-friendly, because that can mean a whole range of other things. And on your point on integration, I think based on all the evidence and all the analysis, I think more integration makes sense rather than less integration, including, by the way, in services. But for that to happen, you need to operate by certain rules and principles. And in the countries in the region, they need to have a uniform set of rules and common understandings on what they mean, including on customs or tariffs, dispute resolution. There are all kinds of things. I'm certainly not an expert on them. But why integration makes sense, and not that every country closes itself off, is, I mean, and when you come to services and all, you need to work on issues such as data protection and all. Those are all true. But let's not throw the baby out with the bathwater. Because two things, integration is also risk diversification, because if you have multiple trading partners across multiple goods, a shock in any one good or one commodity or one country does not upset your whole growth trajectory. So just by common logic, it's like portfolio diversification. It makes sense. Not only that, it allows gains from trade, from specialization, all the things we learn about even in our textbooks. So certainly, I would say, in fact, if anything, the case for more integration in a rules-based framework makes sense. I mean, it shouldn't turn into a complete free-for-all, but within the rules, there are many more gains to be had from that.
I think we are out of time, but we started 10 minutes late. So if anybody needs to leave, please leave. Other than that, we'll have 10 more minutes. Just two comments on this discussion. I think war always creates this opportunity for some who wants to benefit. Lithuania became the largest exporter of wine to Russia. Lithuania doesn't produce wines, but it's a #1 country that exports it. I think Latvia is #3. So it's not unique for this region. It's typical to war situations around the world. So that's #1. #2, I think, just to echo your last point, I think Central Asian countries are benefiting greatly already by trading with each other. And if you are absolutely right, it's still the kind of very low degree in terms of potential that they have. But last several years, we saw great increase of trade between, let's say, Tajikistan, Uzbekistan, which was non-existent, or Kyrgyzstan and Tajikistan. Afghanistan now trades more even with the neighbors, which is most isolated probably country. So we see growth generated by trade inside of this region. Of course, potential is still sky is the limit, but reality is that, and it doesn't contradict what you said. It's obviously trend is that everyone wants economic nationalism is growing, but there are some elements in this region that are probably more advanced than other places because of understanding now of importance of regional trade.
I mean, if I can just pick up on the last point, I mean, what gives me hope for the region is that this trend that you rightly mentioned of integration, closer cooperation is coming from the very top. It's true, unless you have political support, technocrats cannot make it happen, but there is strong political support at the leaders level. And when they meet annually for their summit meetings and all, they have made a decisive push that look, let's set, we've had our issues, we worked with them, you've seen that go through it. I'm not an expert on the politics of it, but certainly we're seeing it. But this direction is coming from the top, and that gives me hope that this is real and it's happening. And it might be from a low base, but that just means that there's a great opportunity to catch up. And as I've shown in one of the charts, what we found was that the benefits are tangible and quick. You don't have to wait 20 years for the benefits to show up if they move along. So that gives me.
Maybe one last question, if there's any question from the audience. Please.
So on capacity building, and
Please introduce yourself.
sorry, John Pester, I'm a sanctions and customs attorney with focus in the region. On capacity building in the middle corridor, how much does that depend on sanctions? We talked about the war in Ukraine, but is there any reticence on the part of the private industry to invest in capacity building because they think in 20 years the US and Europe will be friendly with Iran and Russia again? Is there?
Well, I'm not an expert in sanctions, certainly, but I haven't heard that kind of discussion at all. I think it's more, there are two issues that have surfaced. People talk about the middle corridor, but there's just not one middle corridor. That's one thing. And the other is, that's still a fairly northern thing, but there's a lot of scope even in the southern parts and southern Uzbekistan, Tajikistan, to be part of this connectivity, I would say more broadly. So I think that's, but the main issue from what I gather is that there's just a lot of, logistical issues right at the border that can be sorted out that haven't been. And I think that seems to be the first order of business. That's a priority. That's it's just very difficult to move goods across and different regulations, different, phytosanitary conditions and this and that really impede this kind of thing. But that's something that can actually be solved if there is a more push to do that.
Any last comment or question? If not, then I'll say that I think what we saw today in this presentation and follow-up discussions is obviously the region is very dynamic. I mean, it's just a lot of moving pieces and the growth that is remarkable in terms of compared to other regions of the world is there. I'm sure the war factor is great contributor, but once it will be over, we'll see this region still growing economically as long as policy remains sound and the focus remains on integration and the policy reforms. We'll see this region growing. Definitely, Central Asia will grow because of the resources these countries have and this region has, and interest from all over the world and the scale of the investments. If you look at the FDI committed or FDI already in place in Central Asia, you see that these countries will grow significantly. So with that in mind, probably we'll come back in, I don't know, 6, 7, 8 months and have a follow-up discussion, see where we are in terms of political developments, how this will impact this region. And I would like to thank Subir for his willingness to work with us and come at least once a year, sometimes a couple of times a year, and will talk to us and share his knowledge and his staff's experience and knowledge from the region. And we greatly appreciate that. So let's give him a round of applause. Thanks to everyone who helped us.
Thank you.